Hi there, I'm Michael Linden, a fellow at the Roosevelt Institute, and I'm here on behalf of TaxMarch to talk taxes. I know, you're excited. This time we're here to talk about the federal income tax system and to clear up a little bit of confusion. We're going to talk about the difference between marginal and effective tax rates. Buckle up. As you probably know, our federal income tax system has something called tax brackets. These are basically just thresholds of income after which there is a new tax rate. Your tax bracket depends on your total income after taking out deductions and exemptions, but don't worry about those, that's a topic for another video. The more money you make, the higher your tax bracket. But, and here's the important part, the tax rate in your tax bracket does not apply to all of your income. It only applies to the income above the threshold for that tax bracket. Income below that threshold gets taxed at the rates of the lower brackets. So what that means is that everyone's first dollar of income, whether they make $1 billion a year or $10,000 a year, gets taxed at exactly the same low rate. So even if you're in the top tax bracket, and today the top rate is about 40%, your overall rate, or your effective rate, is actually a lot lower than that, because all of your income up until that top threshold is taxed at lower rates. Your marginal rate, however, is 40%. That's how much tax you would owe on the next dollar you earn. If you're still a bit confused, don't worry. We're gonna do a quick example together. Imagine a world in which we have 3 tax brackets. The first bracket starts at 0 and ends at $40 with a tax rate of 10%. The second bracket starts at $40 and ends at $80 with a tax rate of 20%. And the top bracket is anything over $80 with a top rate of 40%. In this pretend world, we have a rich gentleman by the name of Gil Bates. Gil Bates has $100 a year. That puts him squarely in the top tax bracket. But as we discussed, Gil's top bracket tax rate does not apply to his first $40. For his first $40, the tax rate is 10%, or $4. Then on his next $40 of income, that's the income between $40 and $80, he pays a tax rate of 20%, or $8. And then finally, he pays 40% on the remaining $20. That's $8. So Gil's total tax is $4 plus $8 plus $8, or $20 total. So even though Gil's marginal tax rate is 40%, meaning he would pay 40% on the next dollar that he earned, his total effective tax rate, meaning the total amount of taxes he actually pays, $20, divided by his total income, $100, is only 20%. Back here in the real world, this is exactly how it works. Rich people do pay higher marginal tax rates, usually. Sometimes they use special loopholes and special tax rates. You know what? That's a topic for a different video. They do pay higher marginal tax rates, but their effective rates, what they actually pay in taxes, is much lower than what their marginal rate might suggest. So there you have it, folks. That's the difference between a marginal rate and an effective one. Share this video and you will receive all of these $100. What? No? No, they won't? Okay, sorry, but you should still share the video.